The markets moved towards you. They were looking for 6 cuts this year. It was ridiculous. We're now looking for like 1 or 2. Can we just start with what you think of the recent economic data, the information we've sort of got our hands around over the last couple of days?
I think it's consistent with what we're seeing in the whole first half, which is if you look at the second half last year, then the numbers coming out were a little bit pleasing for economic growth, probably a little bit pleasing for inflation being lower than we expected, and the labor market continued to be very robust. You get into the first half of this year, and the economic numbers are probably a little bit weaker than we thought. The inflation numbers are a little bit higher than we had anticipated. And for the first time, we're seeing just a little bit of looseness in the labor market. I don't want to overstate that because I think, the labor market is still in very good shape. But I think in both cases, the economy is strong second half last year, you can't cut. Inflation a little bit higher than you want this half, you really can't cut. So, Jonathan, I think 25 basis points here or there, who knows, right? There's no precision in this. But by and large, I think the risk for the Fed, the risk for the chairman, is to cut too early before there's any economic weakness and then having to reverse course as inflation, begins to grow. So my sense is they're going to be patient. They're going to be, everyone's used this word data dependent. But until we see a weakness in the economy or inflation really down to 2%, then they're just not going to cut.
Both the economy and the market have surprised a lot of people. I talked about expectations in January, where we were then, where we are now. Let's talk about where we were last spring.
Yeah.
Last spring, if we were sat around this table, the majority of people were speaking to Lisa, to me, to Anne-Marie, and they were telling us that what we're going to see is a real tightening of financial conditions. Banks won't be able to lend as much anymore. Companies are going to suffer.
Yeah.
Here we are 12 months later, credit spreads are super, super tight, and credit availability, particularly for large companies, is there and ready for everyone, even with rates of 5.5%. You've got your finger on the pulse of this. Have you been surprised by that, the availability of credit to this economy still with interest rates where they are?
By and large, no. And I think sometimes there's an advantage to travel. A lot of times there's not. But I spend a fair amount of time in the Middle East and in Asia. And when you listen to people there looking at what's going on in the U.S., it was, okay, waited too long on taming inflation, raised rates 550 basis points in 9 months. We all know the economy is going to collapse, and it's kind of like, really? Like, the economy is still there, the labor market's still there, and it's so clear to me that we have such a competitive advantage in this country with the depth and breadth of the financial services industry, and I think it's a real asset. Europe doesn't have it, China doesn't have it. Hedge funds, venture capital, private credit, all of these ways to get credit into the economy, into small businesses, into middle market businesses. We have many investments with Cascadia in Seattle and Austin, with Marshberry in Cleveland, investing in advisory platforms for middle market and family-owned businesses. And it is incredible how many angles we have to get credit out into the economy in this country relative to other countries. And I think it has, I think looking at the U.S. from outside, there's real admiration for how did we manage this with 550 basis points in 9 months and the economy has stayed relatively stable.
There also is a question underpinning that, which is how effective is Fed policy and really having any influence whatsoever on credit growth, et cetera. There's a theory that the economy has just been a whole lot more resilient to rates as they go up to 5.5%. Is anyone talking about how rate cuts won't necessarily have any effect whatsoever on the economy also, especially just peripheral ones, because of all of this credit creation already in the system?
I think there's a lot of people that have an axe to grind. If you're in commercial real estate, you want to see rates come down for kind of the sector that you're in. But you mentioned history, Jonathan. Yeah. If we take a more historical look, since 2008, the great financial crisis, 2008 until the Fed started raising rates, Fed funds averaged just under 1%. If you look at 2, 3, 4 decades prior to 2008, Fed funds would have averaged about 4%. So I think we're in a much more normal environment right now. And I think the worst thing that could happen is that we saw the Fed, if the Fed starts aggressively cutting rates, it's going to be because the economy is weak. And so that's not necessarily good news. So we're not rooting for Fed rate cuts, but we do think if you look out over the next couple of years, rates in the 4 to 4.5%, 4.5 to 5% range is probably the logical explanation. A bit lower than here over time, but not below 4%.
We've been talking about is good news, bad news, bad news, bad news, bad news, good news. For smaller companies, it has been bad news regardless, it seems like, over the past couple of weeks. And for small banks, regional banks as well, in particular, the KBW index is down some 12% on the year, really down sharply over the past couple of sessions. Do you think that rate cuts will eventually be positive for these shares? Or do you think that there's some sort of structural issues with holdings and other potential challenges that just make it bad news is bad news for them no matter what?
We have a strategy to invest in regional banks, so I do have a bias here. We see a great opportunity. And kind of if you turn that on its head and say, you're a strong regional bank, you've addressed your capital issues, and we all know that higher interest rates were impacting their treasury portfolios, as they have for every bank, and they've impacted loan provisions. But let's just, pick an example of an investor like us investing in a strong regional bank, so the capital levels are fine, there's no issues with the portfolio, and then look forward. You're really doing well with interest rates at this level. Higher interest rates are really good for banks. And it's been a long time since we've seen loan demand like this. So the go-forward position for a strong regional bank is actually outstanding. The question is, will we see consolidation, which we believe we will, and are there strong banks, which we believe there are?
Okay.
And I think one of the great attributes for again, you go back to the depth and breadth of the financial services industry in the U.S., the fact that we have these regional and community banks providing a service that the larger banks can't to small family businesses is a real strength.
You talk about consolidation. I wonder how much is going to be consolidation and how much is going to be failures. Yesterday, there was Access Financial, the latest potential target of some bad research, and a lot of it stemmed around its commercial real estate holdings. Some people argue that lower rates will actually cause property prices to go down because it will allow more sales to kind of get unleashed in the market. Do you think that there's going to be a rash of failures, that basically it's sort of like people sniffing out cockroaches, and if they smell something that's not okay, they just pull their money, and that's sort of a self-fulfilling prophecy? Do you expect that kind of activity to sort of come back?
Well, I think in our view, one thing that is certain is that since 2008, when the regulators and the political leaders claimed that we will never see too big to fail again, the larger banks in the U.S. have gotten bigger, more concentrated, closer to government, and far more systemic. So they're safe, the economy is good, but it's in no one's interest to allow the larger banks to continue to acquire the smaller banks. What we think is appropriate is that we strengthen some of the strong regional banks, whether that it's the capital markets, whether it's Atlas Merchant Capital doing investments, to give them the capital levels that are necessary for them to acquire some of the banks that I think are too small to succeed. Really, really good banks that have been more like community banks that have had good, solid ROEs for decades. But in this environment with the shock in rates, they have to adjust their treasury portfolio. With the loan loss provisions, they have to adjust that. And the thing that is more permanent is the regulatory intrusion post-SVB will increase their costs around technology and KYC. So we do see an environment where consolidation is a positive and a natural, as opposed to weekend failures and big banks taking them over at the last second.
We started this conversation by talking about some of the misconceptions people had from the outside looking in, from outside of America looking inside America. From inside the financial system, what do you think is the biggest misconception that people in Washington have about the world you work in?
I think they misunderstand what has happened over the last 14, 15 years since the financial crisis with larger, more concentrated, more systemic, the big four, the big eight, if you look at the top banks. I think, between the top 2 or 3 banks of Wells Fargo and Bank of America and JP Morgan, it's over 50% of the deposits. And we saw a recent report where if you take 4,500 banks in the U.S., JP Morgan alone is 20% of the profitability. So banks are more concentrated. And I think what they're missing is the value to the economy of having a strong, robust regional and community banking sector. And I think for us, that is an opportunity over the next couple of years. And I think the thing that is really, really key here that people miss is the go forward. If you are a healthy bank, the go forward with higher interest rates and loan demand is outstanding. The question is, are you ready to be investing and are you ready to be lending?